Let us look at the key features or the characteristics of international diversification when it comes to stock market investing. Mastering international diversification, for stock market success. So international diversification, in stocks actually involves spreading investment across global markets to reduce risks and to be able to access growth opportunities in different countries. And these are the key features you want to take into consideration as it relates to international diversification. Number one is global exposure. Global exposure. You discover that as a global investor, a globally diversified investor, you have that exposure to diverse economies, including both developed, underdeveloped and emerging markets. So you are exposed to uh, all these countries, all these economies, and that will help you to not only enhance returns but to mitigate or reduce your risk. Number two is risk reduction. Risk reduction. There's this lower correlation between markets, between countries, between economies. Some economies don't tend to correlate when it comes to phases in investment or phases in the economy, in economic developments. I discovered that it helps mitigate specific risks and equally reduces market volatility. When you invest globally, when you adopt this particular idea or concept of international investing, you discover that you are least exposed to volatility that may be present in your home country. Number three is higher growth potential. There's that particular potential for higher growth because emerging markets, as you all know, offers faster growth compared to developed economies. Because emerging markets are just like children, they're like toddlers. They grow faster than they grow faster than should I say adults. Kind of they are in their growth stage compared to adults that are like in their mature stage. They don't really like grow that fast, and so you have that exposure to higher growth potentials. Your portfolio will tend to do better than if you are resident in a developed in a developed country. You have this particular advantage. Number four is currency diversification. Usually, as I'm a global investor, you are kind of exposed to different currencies that can act as a hedge. It acts as a hedge, a hedge against, domestic currency fluctuation. Discover that even when your domestic currency is undergoing fluctuation, it might be devaluated, it might be devalued kind of, it might undergo kind of currency devaluation. Such doesn't really occur in other countries you are invested in. And so you escape in a currency crisis that that may occur in your own country. So you are diversified across different currencies. Number five is broader sector exposure. You are exposed to different countries. Actually, have that core advantage. They tend to they have that expertise in provision of goods and services in different, in peculiar sectors that are not really that are not in your home country. When it comes to let's take for instance, global e-commerce. Amazon is a very good example. So, which may not really, your country may not have an equivalent of Amazon. I want to really take advantage of the growth, in global e-commerce. You can invest in Amazon, even as even as somebody based in Nigeria or in other country. You can invest in Amazon. It's a US stock, and then you could enjoy the benefits of that, broader sector exposure. Not only that, number six is enhanced stability. Is that enhancement when it comes to how stable your portfolio is. You discover that global diversification can reduce portfolio volatility. As different regions actually do not really correlate when it comes to uh, you know uh, volatility and fluctuation. Caused by difference. Kind of different economic cycles. So they don't really tend to correlate. So you have that safety, you are guaranteed that stability because of that lack of correlation, when it comes to different companies in your portfolio. Number eight is access to global companies. You have that access to global brands. You could be in Nigeria here, you can invest in Sony, Japan, you can invest in LG, South Korea, you can invest in Amazon, the US, you can invest in Unilever, Britain, countries like that. You can invest in Mercedes-Benz, Germany. So you have that kind of that kind of you know access to global companies. You equally have geopolitical diversification, and this mitigate risk tied to geopolitics and economic events in one country. Not only that, number nine here is you have that tax benefit. Some countries offer a kind of tax incentive to foreign investors, so you could benefit from the incentive or the tax exemption the company offers to people coming in to invest in the country. You could benefit from it. If you accumulate the money you save on taxes over time, you discover that it's something that is quite is tangible, it's enormous, it's significant. Number 10 is global funds. So ETF and mutual funds provide easy access to international stocks and markets. Discover that exchange traded funds and other mutual funds, they have this country-based or sector-based funds, and when you invest in them, you have that global exposure to countries wherever the constituent stocks are based. So you have that opportunity for global fund to access global funds. Number 11 is economic cycles. Different countries may experience varied economic cycles, offering opportunities in regions not impacted by domestic downturn. If your country is going through a kind of economic downturns, other countries you may be invested in, may not experience a similar, financial or economic condition. So you stand to benefit from other countries in stable economies. Number 12 is liquidity and access. Liquidity and access. Discover that some foreign markets may have lower liquidity, and access, could be restricted. In a case where there's that restriction in access to you as to investors, other countries may not be like that. You discover that you have liquidity, you can very easily buy and sell, and you have easy access to stocks in those countries. In case your own country has that kind of problems, you have the leeway, the liberty to invest in other countries that do not have do not encounter this kind of problem. Number 13 is ESG opportunity. ESG means environmental, social, and governance. So actually, global markets offer opportunities, for sustainable investing. If you're the type that wants to invest, with your value in mind, you want to invest based on your value, you want to invest based on the impact you want to create either in the community or socially, environmentally, you support sustainability, you want, you could go into investment like green energy, sustainable, renewable energy, sustainable agriculture, and other related, fields. So it offers opportunity for, value-based investing. Number 14 is regulatory differences. You discover that different countries have various, varying regulations affecting market transparency and stability. In some cases, your own home country may not be very, very transparent when it comes to the way they conduct things and conduct business, like in some third world country. So you could benefit from the transparency that is obtainable in other, advanced countries, and that would be like a kind of, relief to you, because you believe information posted there you could get from those countries are genuine and they are like transparent enough. You could take decisions based on them without fear of losing your money. So international diversification helps to balance risk, improve returns, as well as provide exposure to global growth. Not only that, it requires careful consideration of risks such as currency fluctuation, political instability, and market access. So when you want to invest globally, you consider the risks involved. How is the country's currency doing? Is there, a kind of unacceptable level of fluctuation? Is the company's currency being devalued? And equally consider political, instability. You can't invest in Lebanon. You can't invest in Syria. You can't invest in Yemen, all those countries like that. So you need to take this into consideration. I also want to, consider market access. For now, investment in Russia, I don't think it's possible. You may not invest in Russia for now, if I'm not mistaken. So all these things I think we need to consider before we dive into international diversification as investors.